Hello friend, I am your friend Kaustav. Today in this video we will discuss about the recent change which Government of India has been done on debt mutual fund. If you are an investor, so this is important information that you need to know. Let's dive into it.
The recent changes in the taxation of debt mutual funds, as per the Finance Bill 2023 passed by the Lok Sabha, has become a hot topic among investors. The amendments made in Budget 2023 will impact how investors approach debt mutual funds and their investment strategies. Let's take a closer look at the changes and how they will affect you. Firstly, the change in debt mutual fund taxation means that no benefit of indexation for the calculation of long-term capital gains on debt mutual funds will be available for investments made on or after April 1, 2023. However, this change will only apply to debt mutual funds where equity investments do not exceed 35% of the portfolio. Therefore, from April 1, 2023, these debt mutual fund schemes will be taxed at income tax rates applicable to your income slab. Before this change, income tax laws allowed taxation of debt mutual fund schemes on the basis of a holding period. If the unit was redeemed on or before the completion of 36 months, the gains were called short-term capital gains and were taxed at tax rates applicable to the investor's income. However, if the holding period exceeded 36 months, then the gains were called long-term capital gains and were taxed at 20% with an indexation benefit. The recent changes in taxation of debt mutual funds will impact other mutual fund categories as well. Indexation benefit will not be available in the case of long-term capital gains on gold mutual funds, international equity mutual funds, fund of funds, and hybrid mutual funds. Currently, long-term capital gains tax is applicable on gold if the holding period exceeds 36 months. The same is the case for international equity and other mutual fund categories, except equity mutual funds, as well. From April 1, 2023, gains from debt mutual funds, where equity investment does not exceed 35% of the scheme portfolio, gold, and international equity will be taxed the same as income from bank fixed deposits. However, it's important to note that there has been no change in taxation for equity shares and equity mutual funds. They will continue to be taxed at 10% without indexation benefit, provided LTCG exceeds 1 lakh rupees in a financial year. In conclusion, the recent changes in the taxation of debt mutual funds will affect investors' investment strategies and the returns they receive from their investments. It's important to consult with a financial advisor to understand the implications of these changes and adjust your investment strategy accordingly. Thank you for watching, and please subscribe to our channel for more informative videos.
I think few funds would be benefited out of this. Fund like equity savings fund, where they have 35% exposure into debt fund and the balance they will put into arbitrage and in equity, which has debt like return and equity like taxation. Along with that, balance advantage fund and other balance funds also will be benefited out of this particular move.
What is debt mutual fund? Debt mutual fund is a type of mutual fund where the majority of the funds are invested in fixed income securities like bonds, debentures, and government securities. Debt mutual funds are considered a low-risk investment option and provide a stable source of income to the investors. Types of debt funds. There are different types of debt mutual funds available for investors to choose from based on the maturity period, risk profile and investment objective of the investor. Overnight fund. This fund invests in securities which have a maturity period of 1 day. Overnight fund carry minimal credit risk and interest rate risk owing to such a short maturity period and are hence perceived to be relatively stable. Liquid fund. Liquid fund invest in debt and money market securities with residual maturity up to 91 days only. The underlying instruments are fairly liquid and have the potential to offer reasonable returns than traditional avenues. Some liquid funds also have the option of instant redemption facility which allows redemptions up to 50,000 rupees per day per scheme per investor. Ultra short duration fund. Ultra short duration fund invest in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 3 to 6 months. Low duration fund. Low duration fund invest in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 6 to 12 months. Money market fund. Money market fund invest in money market securities with a maximum maturity of 1 year. This fund is a good alternative to park surplus money for short term. It can also be used as an emergency fund as it is relatively highly liquid and has the potential to generate better returns than traditional avenues. Short duration fund. Short duration fund invest in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 1 to 3 years. Medium duration fund invests in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 3 to 4 years. Corporate bond fund predominantly invests in corporate bonds rated R+ and above. It is a good option for investors having a moderate risk appetite who want to invest in papers having relatively lower credit risk. Credit risk fund This fund predominantly invests in papers rated R and below, excluding R+ rated corporate bonds. Credit risk fund aims to earn higher returns by investing in papers which offer relatively higher interest rates. However, they carry credit risk compared to other debt funds. Banking and PSU fund invests at least 80% of its assets in debt and money market securities of banks, PSU, public sector undertakings, public financial institutions and municipal bodies. Dynamic bond funds invest in debt instruments having varying maturity based on the current interest rates. The fund manager changes the portfolio dynamically depending on the interest rates. These funds are a good option for investors having a slightly moderate risk tolerance and are looking to earn regular income for medium term. Gilt funds invest at least 80% of its assets in government securities with varying maturities. They are considered relatively one of the stable investments as given the exposure to sovereign papers, there is very little credit risk. This makes gilt funds a good choice for risk-averse investors. Note, Macaulay duration is the weighted average time to receive the cash flows from a bond. It measures the time an investor would take to get his invested money in the bond by way of periodic interest as well as principal repayments. It is usually measured in years.
Hope you like this particular video. For personalized financial planning, you can contact us. Disclaimer, we are not registered advisor. We are registered distributor and broker.